Well, good morning, everybody, and welcome, and thank you for joining us for our latest webinar, COVID-19 Planning Opportunities for Owner-Managers. My name is Andrew Gibb from Old Mill's marketing team, and I'll be your host today. Now, we've been running a series of webinars covering the challenges of the coronavirus pandemic in terms of its impact on the business landscape across the region. And today I'm delighted that we have three brand new panelists for you. We want to focus specifically on some of the planning opportunities for owner-managers as we begin to emerge out of lockdown. So tax expert David Maslen will kick things off for us by examining how you can use the tax system to generate additional cash flow for your business by reviewing the opportunities around research and development tax credits and capital allowances. And with the Office for Budget Responsibility projecting that the cost of COVID-19 could reach 300 billion, we will also take a look at where the tax system might go at the end of all of this. Next, pension specialist Steve Woodham will run through the ways self-invested personal pensions and self-administered schemes can be used to support your business from a funding perspective, and how your pension fund could potentially buy property out of the business to inject funds onto your balance sheet. And finally, chartered financial planner Tony Hawes will run through some of the key areas business owners should be thinking about as we emerge out of lockdown from a personal financial planning perspective. The focus of our previous webinars has been around the traumatic impact of COVID-19 on businesses, but really the knock-on effect that certainly smaller owner-managers will need to think about is really about recalibrating their financial plans to meet their future goals and objectives. Now, we usually run with a Q&A format. This morning, we're going to ask each panelist to share what they're seeing out there in their discussions with both clients and contacts in the marketplace. But we're also going to break the webinar into three self-contained sections. And for those of you on the live broadcast, you can submit any questions via the Q&A in the usual way, and I'll aim to feed them through to our panelists as we go. And before we jump in, I just need to let you know that this webinar is being recorded and will be uploaded onto our website so that people can watch on demand at a later date. So if everybody's happy, we've got a lot to get through this morning, so let's make a start. And I'd like to hand over to David Maslen, who is the director in our tax team in Yeovil. Over to you, David.
Thank you, Andrew. As you've said, COVID-19 is obviously having a significant impact on many of our clients' businesses, and we're helping many of them deal with cash flow issues, helping them with forecasting, obtaining funding, or indeed deferring payments of tax. We're also helping clients' cash flows by doing things like extending period ends, for example, which may then be bringing in losses, and that's impacting on the overall corporation tax liability and payment dates. So clearly, with everything going on at the moment, no one wants to pay too much tax. No one wants to pay too much tax anyway. So today I just want to touch really on two specific opportunities which may be available to businesses to reduce their tax bills or even generate a tax repayment. And in truth, these are two areas where UK businesses are still vastly underclaiming the reliefs available. And those two areas, as Andrew has said, are in capital allowances and research and development tax credits. So looking at those in turn, I'll start with capital allowances. And what I really mean here is historic capital allowance claims on property. And again, the truth is there's hundreds, maybe more businesses out there who are unknowingly sitting on a potential tax asset that's kind of hidden in their building. And that is because they've previously underclaimed capital allowances, either when they've acquired that building or when they built it themselves. I won't go into too much technical detail, but capital allowances are how businesses get tax relief on their capital expenditure as opposed to their day-to-day tax expenditure. And there is a basic rule that's grown up in tax law that says if you acquire a capital asset and that asset performs a function in your business, it is plant and it qualifies for capital allowances. Whereas if you're spending that money on an asset that provides a setting, such as a building, it is excluded from plant and it doesn't get a capital allowance. So buildings are actually excluded from plant in legislation, but then there are exceptions. And those exceptions are really the parts of the building that really do have a function. for example, fixtures. And historically, as I said before, capital allowances on buildings have been massively underclaimed, not because accountants don't understand the tax law, but really because they don't understand buildings. We're not property surveyors. And for that reason, lots of buildings have just been assumed not to qualify. So any business, I would say, that has a property held within the business, and that could be an unlimited or limited company, it should be worth just reviewing the capital allowance position on that building. A couple of obvious giveaways would be, look in your financial statements. If you see all the building, a big balance in freehold property and nothing in fixtures and fittings, that tends to suggest that maybe the property had all gone in as a building and not been claimed. Alternatively, look in your tax computation, and if there's a huge balance in non-qualifying assets, again, it suggests that something may have been missed. What do you do if you have underclaimed? Well, what you can do is you put in a claim now, and you can go back into a tax return up to 2 years and amend that return by including a claim. It doesn't mean the building has to have been bought in the last 2 years. The building can have been bought 10, 15 years ago. You can't open up the return from 15 years ago, but you can go back 2 years to include that building. And what that will do is, you'll generate additional tax relief. You'll generate a tax repayment in respect of any tax previously paid in that year, and you'll reduce tax liabilities now and going forward. So if you've got buildings, just make sure you're claiming your capital allowances. Research and development tax credits is another area. And like capital allowances, this only applies to limited companies. So this is only relief available to limited companies. So what are research and development tax credits? They've been around since 2000. Basically, they're a government incentive to reward UK companies for investing in innovation. They can provide a valuable relief so that those companies can get tax back, invest further in the business, invest further into research and development. The take-up for R&D tax credits was initially very slow. It has been increasing, but there are plenty of reports showing that, again, there are hundreds, nay, thousands of companies out there who could be claiming R&D tax credits that still aren't. Why is that? I think there's just still a misconception. The phrase research and development, people form images of people in white coats, laboratories doing kind of science with test tubes and things like that. And a misconception that it only applies to certain industries. And as I say, there are a misconception. How does R&D tax credits work? Well, if you have a company that is spending money developing new products, new processes or services, or even enhancing existing ones, that can claim R&D tax relief. Again, if you make a claim, you can reduce your tax liability now, or by making a claim in prior periods, you can achieve a tax repayment. Indeed, for most companies, when there's a first year they claim it, it's actually a 2-year claim because you're reopening prior year computations and amending them. And you do tend to get a generation of a tax repayment, which is cash in the bank, and as well as the benefits of reduced tax payments going forward. Who qualifies? Well, it really is any sector. We're doing claims that range from the food and drink sector through to engineering, agriculture through to digital development. It is not sector specific. And if we look at, well, what counts as R&D, the criteria are pretty broad, but in basic terms, if your business, if your company is taking a risk to solve a scientific or technological uncertainty, then that is likely to be a qualifying activity. Without delving too much into the detail of what that means, if you're entering or embarking on a project where you don't know it's possible, you don't know whether this is going to work, is it going to be commercially viable, but there's risk that you're going to spend money, you might come to nothing. That's pretty much, starts to look like it could be R&D. How much is it worth, R&D tax credits? There are actually 2 schemes. We tend to focus on the SME scheme because that applies to most of our clients. And what that means is for every £1 of qualifying expenditure that company makes, the company actually gets tax relief of £2.30, so you get an enhanced deduction. Broadly what that means is if you spent £50,000, let's say, on qualifying R&D spend, you could get a tax repayment of £12,350, which is kind of nice money to have. So again, a bit like capital allowances, if you're running a trading company and you've not done an R&D previously, particularly if you've not even considered whether you're doing one, go and speak to your accountant, take a look now, and really look at whether you can be making a claim. So that's two kind of immediate ways of potentially getting funding off the revenue. I suppose as we look forward into future funding of the business, as bad as the current environment might be, what it will do is it will create opportunities for existing businesses, and it will also bring new players into new markets. And in many cases, those businesses will require funding in order to get their ideas off the ground and take advantage of those opportunities. I don't need to tell you there's many forms of funding available. It's not the scope of today for me to kind of talk through that. But what I will do just briefly is just mention two tax reliefs which have been created by the UK government, have been in play quite a while now, which are designed to encourage investment into startup and early stage businesses. And that's, they're called Enterprise Investment Scheme and Seed Enterprise Investment Scheme, EIS or SEIS for short. And just briefly, they work by giving the investor a significant income tax and capital gains tax relief for making equity investments into eligible companies. So they are highly valuable. The government is using them to encourage investment into SMEs, basically. There are limits on funding, and there's a myriad of hugely complicated conditions and pitfalls you can fall into. But again, if for any business owner looking to raise equity finance to get their business off the ground or to take advantage of opportunities, or indeed entrepreneurs with money to invest in such companies, then EIS and CDIS is definitely something that's worth considering. Okay, so the last thing I've just been asked to talk about briefly is what the tax system might look like going forward. This is the bit where there's kind of no facts to this. This is kind of crystal ball gazing. I suppose with all the uncertainty around COVID-19, one thing that does seem beyond doubt is that there will come a point in time when taxes will have to rise. Andrew mentioned earlier on, a budget deficit of 300 billion. Who knows what's going to happen if we have some kind of second spike. Now, it looks like a chunk of that 300 billion could be covered by government borrowing. The government appear to have ruled out, a return to austerity. So, whilst tax rises are never popular, it might be a way for the government to show that they are dealing with the deficit and are bringing it under control. Now, as a tax advisor, it's quite an interesting scenario to be in, because when we're working with clients on tax mitigation strategies, there's kind of two priorities. First priority, find the route that involves paying the least amount of tax, i.e. look to save tax first. And then secondly, if you can't save tax, look to defer it to a later date. Now, interestingly, if we're in an environment where there is likelihood of tax rises, you can see scenarios whereby clients may be choosing to crystallize a tax liability earlier, or do some planned event earlier, in order to try and lock in the tax rates that are in play. I mean, just briefly, what might take place, where these rises, as I say, it's all conjecture really, but there was a leaked document from the government identifying various areas where they might look at such rises. Business tax would be one of them. The government have already rode back on the reductions to corporation tax. That's going to stay at 19%. They're going to be under pressure to kickstart the economy. So is that an area they're going to attack? Seem perhaps more likely that they'll go after some wealthy individuals and perhaps look to reform some of the areas of taxation where before it's either been logistically or politically too difficult to really attack. Income tax is an obvious one. I saw a number the other day, and across the board, 1% rise in income tax would generate 4.7 billion of revenue, additional revenue. The government, of course, in their manifesto pledged not to raise income tax, but are we in a situation now where all bets are off? The world has changed since then. Could they row back on that? Another, we'll call it another U-turn, but we're in a very different scenario now. National insurance does seem to be an area which is likely to fall under attack. At the moment, as employees, you're basically paid 12% employee national insurance on earnings up to 50,000, 2% thereafter. Will they look to move the whole thing up to 12%? NICs and self-employed, the Chancellor has already given notice that this is an area that he's going to have a look to go at. He announced this when announcing the Self-Employed Income Support Scheme. Self-employed paid Class 4 national insurance at 9%. Employees paid 12%, as I've said before. Will they look to move the rates in line? Will they even look to include employer NICs in that self-employed rate? Pensions. We've got tax relief for high earners. Apparently that costs the Exchequer £38 billion a year. Very valuable relief. It's been talked about every budget for as long as I can remember, about whether they'll get rid of it. Politically, they've never had the appetite to do it. Has he now got a once in a lifetime opportunity to change that? My message here for any business owners, particularly company owners, pension contributions is the single most tax efficient form of extracting income from your company and providing for your family's future wealth. So whilst I'm not giving financial advice, obviously, just to calm Tony down later on, I would always encourage business owners to use that relief where available. Other forms of tax, capital gains tax, probably most people are aware that capital gains tax rates are lower than income tax. Will they look to merge those rates? That could be an area for tax. And then finally, wealth tax has been mooted. It's been argued that taxing people now on their wealth for a problem now is more fair than taxing future generations on their work. It's been done before in other countries. Clearly would create huge practical and logistical issues, but it's on the table. So in conclusion, I'll wrap up because I'm just about coming up to time. We can't predict the future. The main message is, whatever you do, take the most opportunity of the tax reliefs available. Capital allowances, R&D, pensions, EIS are just some of those. These are not aggressive tax avoidance schemes. These are government-backed reliefs designed to encourage taxpayers to do certain things that benefit the country. So do make sure that you are claiming all the reliefs available to you. Okay, that's me done. Hopefully not too far over time. Thank you very much.
Thank you for that comprehensive overview, David. That was fantastic. We've had a question that came in whilst you were talking, and I guess this relates back out. Feedback I've heard from advisors on the ground is there's been definitely an uptick in kind of R&D activity out there in the marketplace. So it's one of the attendees has asked, I've been approached by an R&D claim specific company, no win, no fee. Should I go with them? I'm not sure whether you've got a view on that one.
It's a very interesting and topical and relevant question. So yeah, if it's okay, if I've got time, I will answer that. We have a number of clients being approached in similar ways. We do a number of R&D claims for a huge number of clients ourselves, and on some clients we also subcontract that work to so-called specialist houses. So we're very happy to work with them. The R&D market is a bit of the Wild West at the moment, I would say, from a tax perspective. There are a lot of operators out there, accountancy practices, specialist houses, and there's a vast range of quality of advisor out there. I would always recommend, if you were going to an accountant or a tax advisor for any form of tax advice, think of the kind of questions that you would want to have some kind of confidence in. Are they regulated by one of the accountancy or tax bodies? You know, would you be covered for in the event of inquiry? There are people out there who will sell you a story, but if you start to dig beyond that, they're interested in getting in there. They might get you a quick tax repayment, and then you may never see them again, and they may not be there when HMRC inquire. So I treat it with caution. It is a very varied market. HMRC are actually addressing this, and they're consulting with the tax bodies to try and bring control to that market. But for the particular person who's raised this question, I'd be very happy to talk offline about the approach that they've had, and talk them through whether that's the right thing for them or not.
Thank you, David. Okay, let's move on. So next up is Steve Woodham. Steve's a senior pensions manager at Old Mill. Steve runs our specialist pensions team and is a member of the Association of Member-Directed Pension Schemes. I understand that there's some interesting things that owner managers can do in terms of unlocking pensions to inject funds into their business. So really over to you, Steve.
Thank you, Andrew. Good morning, everyone. As Andrew said, I run a specialist team at Old Mill looking after self-invested pensions. Just a little overview, there are two types of self-invested pensions. One is a self-invested personal pension, and another is a small self-administered scheme, which is a company pension scheme. I'm going to talk about three topics this morning. Firstly, as David has touched on, the tax benefits of pension funds. Also, in a little bit more detail, I'm going to talk about property and how a pension fund can help you purchase property and how you can unlock some existing pensions. And finally, I'm going to talk about loans that could be available from a pension fund. So firstly, just to remind you regarding the tax benefits of pensions, the position as it is at the moment is that company contributions, as David has already mentioned, benefits from corporation tax relief. So a very valuable benefit and tax saving that you can make. In addition to that, members and directors can make contributions to their own pension schemes, and they will be subject to no income tax, those pension contributions. So, for example, a £100 pension contribution would actually just cost the contributor just £60, and the other £40 would be saved through tax relief. Once you get investments into a pension fund, they grow tax-free as well. So there's no capital gains tax on any assets that are held in a pension fund. And finally, another significant tax benefit of pensions is that they are outside of an individual's estate for inheritance tax purposes. So the main reason we would start a pension fund in the first place would be to fund an individual's retirement. And so far I've talked about the way we put pension money into a pension scheme through contributions, but also I want to look at existing pensions and how they can potentially help business owners. Now, usually you wouldn't be able to unlock a pension fund until you drew benefits, and the minimum age that you can draw benefits at the moment is 55. But there are a couple of ways that you could use those existing pensions to potentially help your business. That is through property purchase and also through potential loan. So firstly, I'm going to look at the property purchase. Now, a self-invested pension fund, which is what we do here at Old Mill, we can buy a property from any party. So that can be from a third party, it can be from you as individuals, or it can be from your company. And if you did, for example, you had a company that owned the business premises, you could potentially sell that property to your pension fund. That would have a big cash injection into your company, and also you would be a trustee along with the pension provider, so you would still contain control of the property. You would just be holding it in a different entity, so you would hold it in a pension trust rather than in your company or personally. So how that potentially would work, if you haven't got a self-invested pension at the moment, you can look at potentially unlocking other pensions and you can transfer them. So a traditional pension fund, you could transfer a pension to a SIP or a SEIS. Basically, you would turn it into cash. Now, I don't say transfer a pension fund lightly because there are certain requirements and potential risks in doing that. So we would always recommend that you get advice from a financial planner before you consider moving any pension to a self-invested fund. Once you've achieved that, you can then look at potentially buying your property. If you haven't got enough money in the pension following the transfer, you can add money through contributions. And also, point to remember is a pension fund, like an individual can get a mortgage to buy a property, a pension fund can also have a mortgage to buy a property. So you can build up the funds within your pension through pension transfers, contributions and borrowings to make sure you have sufficient funds in there to proceed with a property purchase. We can also consider partial purchase if you haven't got enough to buy the whole property, or what is very common is a joint purchase. Now, we do see many individual SIPs that join together to buy one property, and if we have a SEIS, which is a company pension scheme, we normally have up to 11 members. Typically, our SEIS run between 3 and 6, but as I say, you can have up to 11 members. So directors and senior employees can join their pension funds together to buy a property. Now, as I said, usually you wouldn't be able to unlock pensions until age 55, but for using a self-invested pension fund, you can inject that cash into the business. The type of property that a pension fund can buy is any commercial property, so things like offices, retail units, industrial units, factories, and even land. The rules do not allow residential property purchase, but there are some very specific work-related residential property exemptions that I can talk to anyone about offline if we wanted to consider that. Once the pension fund has bought the property, the company or a third-party tenant would then pay rent into the pension fund. And there are tax advantages in that as well. The rent would not be subject to tax, and when it's in the pension scheme, if you're receiving rent or income as an individual, you would normally be subject to income tax, but through a pension scheme, it wouldn't be subject to any income tax at all. And when it arrives in the pension scheme, it would then grow tax-free. So just give you a little example, we have a manufacturing company that had 3 directors and they wanted to buy the company premises. They had pension funds of £160,000, which they transferred into a SEIS. They then added contributions of £20,000, so suddenly they had a pot of £180,000. They borrowed £90,000, so in addition to the contributions, the transfers and the borrowing, they then had a cash pot of £270,000, which enabled them to buy the company premises for £260,000. So that 260 was a cash injection into the business. And then that property was then rented back to the business, and that rental income was used to repay the mortgage. There are some downsides to property. There are risks in investing in property like there are in any other type of investments. So things like liquidity, a property is very illiquid. So you need to consider that if you're close to retirement. You need some other assets to be able to pay your pension fund, pay your pension income from. And rental incomes are not guaranteed, and also property values can fluctuate. So there's one idea. Another way pension funds can help businesses is through loans. Now, a SEIS, a company scheme, is permitted to lend up to 50% of its value to the sponsoring employer. So if your company had a pension fund that was a SEIS, it could lend money back to you. We've seen a lot of bounce-back loans recently, and also if you needed further funds, then you could potentially look at the possibility of having a loan from your pension fund. There are strict rules regarding the repayment, the security of that loan, and the term of that loan. We do have a leaflet available with those further details should anyone need it. And what I've seen happening in the market over the last 3 to 4 months is I've seen a lot more loan inquiries from businesses that want to top up from their existing bounce-back loan. We've also got some clients who have already got a SEIS in place that have had a loan and just used those existing pension funds to top up their existing loans from their pensions. And with regards to property, we did see at the start of the COVID-19 crisis some property purchases where companies had plans to expand. They were put on hold for a few months, but now things are picking up a little bit. We've seen those start to progress again. And also the revenue do have strict rules regarding the repayment of rent and repayment of loans to pension funds, but we have seen those relaxed over the last 3 months just to allow trustees of pension funds to have the flexibility to grant rent holidays and loan repayment holidays. So in summary, just to back up what David said, there's great tax advantages that can be used for companies from pension funds. You may wish to consider property purchase. You may have plans to expand. You may not have considered your pension fund before. This might be something that could be of help to you. And also, finally, there is a potential loan option from your pension fund. Thank you.
Thank you, Steve. That was fantastic. Some really thought-provoking ideas, which hopefully our viewers will find helpful, particularly in terms of looking at unlocking pensions. So that's great. Just conscious of time, so I'm going to hand over to our next speaker. I'd like to introduce Tony Hawes. Tony is a chartered financial planner who specialises in working with business owners. As I said in my intro, most of the focus in these sessions has been around the government support for businesses in the form of grants and loans. But for the majority of business owners, their personal wealth is to a certain extent intrinsically linked to the fortunes of their business. So we thought it might be useful to get Tony on the webinar to run through the kind of things he's talking about with his clients on a day-to-day basis. So over to you, Tony.
Yes, thanks, Andrew, and good morning all. So what we've heard so far is some valuable tax planning opportunities from David, and Steve's explained to you how pensions can be used to support your business and entitle you to valuable tax reliefs also. There's been quite rightly a lot of focus around support for business, a lot of measures that have been introduced to try to support the situation, both from central government. Owners have had to get really hands-on, driving costs down within their business, adapting business models, looking at marketing strategies and how to best resource things as they navigate through the impact of COVID-19. What I want to do this morning is perhaps change the emphasis a little bit and look more exclusively at the people that sit behind the business, the individuals and the impact on their personal financial plans and aspirations for the future. Business owners may well have had an idea and a vision for when they want to exit the business and life after business, what that might look like. But are we aware? Are we conscious of what impact has been made on those individual plans and aspirations through what we've seen over the last few months? So, a few key questions to look at here. Does this mean that I'm going to have to work longer and invest more time in my business before I can step back? You know, how's this impacted on sale of the business or exit options from that business? A key one would be, you know, can I afford to sell the business for less? What is my number? How much essentially do I need to extract from this business in order to support my desired lifestyle and that of my family going forward? So it's really looking at this from a personal perspective. And essentially my job as a chartered financial planner is to help business owners identify, get and keep the lifestyle that they really want through careful planning. And this has really never been more relevant than today. I've got clients sort of proactively contacting me to have this type of conversation now to try and give them a bit more clarity and certainty over what that means to them. So really a great time to kind of recalibrate your existing plans. And really an important aspect of this, I think, is to forge a closer link between, you know, your personal aspirations and your business performance, and not really consider them as separate issues, so to speak. The good news is that we can help with this, and the way in which we would look to help is to, you know, construct a detailed personal financial plan which really focuses in on the things that are really important to the business owners from a personal perspective, and then linking that back to what changes need to be made to the business and even their personal assets that sit outside of the business to give that individual the best chance of achieving those longer term goals. Just to quickly run you through the kind of steps that are involved in constructing such a plan. Number one, and probably the most critical thing, is agreeing those personal needs and objectives for the future. And what I've often found working with business owners over the last 5 years is that running a business can be all-consuming, particularly you know, in volatile times like we've got at the moment, and consequently there's less time to sit back and have a reflection on, you know, what's the end game, where are we actually headed with all of this. So it's setting aside time to talk about, you know, what things you want to tick off and achieve in the years ahead. Once we've done that, you know, we can look at quantifying the cost of that lifestyle and gathering, you know, factual information about what assets that individual's got, which might help produce income or capital to support them on the journey. We would then agree some scenarios. So a business owner might say, well, for example, let's look at a scenario where I perhaps sell my business at a certain point in the future for a certain amount. And we do have business valuation light tools which help give us an indication of what that business might be worth, taking into account the impact of what's happened. We can look at trade sale scenarios. We can look at scenarios where they might want to retain equity ownership, take a back seat and extract dividends. We can take that into consideration. Then what we'd look to do, and really the key part and the heart of a personal financial plan, would be a cash flow projection. And we can typically look at different scenarios. So for example, you know, projecting forward based on a couple living long and healthy to age 99, or scenarios where one predeceases the other, and what's the impact on the person that remains. So let's have a look at an example of a cash flow, and this is, I've just taken an extract here from a more comprehensive financial plan, but I wanted to give you a flavour of what this might look like. So this page here just shows you a starting point for a financial plan. And what we're focusing on here is the value of an individual's liquid assets. So what cash do they have? What investments and pensions do they have, which are relatively liquid and enables them to draw on that pot of money to sustain their lifestyle. We do also need to make some assumptions about future inflation and the impact of that on their personal finances. And in this example, you know, we've given a long-term assumption of inflation at 2.5%. Andrew, if you want to move on to the next slide. So I talked earlier about gathering factual information, and as you can see here, here's an example. So we'll detail what the liquid assets look like, and input an assumed growth rate. This is an example of a client of mine that I've anonymised for the purpose of this exercise. So you can see there's some ISA investments and some cash in the bank. What we'll then look to do is quantify income, current and future income streams that we can anticipate for the rest of that individual's lifetime. So here's an example here. We've itemised expected income. And as you can see, this particular client made the decision to enter into a voluntary liquidation of their business. They wanted to take a 12-month period, a bit of a hiatus where they reflected, and then start another business venture in about a year or so's time. So we've built in some assumptions there of what they wanted to do. And then fast forwarding the clock, you've got state pensions kicking in at age 67, and then the ability to draw down on some tax-free cash from their pension as well. Okay, Andrew, if you want to just flick forward. Money going out. So the flip side is, okay, we know what that income's likely to look like. What about expenditure? You know, what are our spending plans, our bucket list, so to speak, things that we really want to achieve our desired lifestyle. So this client wants to, you know, allocate money for property maintenance, general expenses, vehicle expenses. And then as we flick through, we can see the typical things really: mortgage, capital expenditure. It was very important to these individuals that their children were privately educated. We take into account what pension provision they have at the moment. So as you can see, there's some accumulated pension savings which are currently uncrystallised, i.e. they haven't accessed previously. And then finally, this all culminates in a cash flow projection. So here's an example of what this might look like. The green bar represents liquid assets, cash and investments. And as you can see, what's likely to happen in this scenario is that liquid assets would tick over at a fairly constant level before being eroded away slowly and eventually exhausting around about age 75. At that point, you'll see the bars above the black line, which represent available pension funds. So whilst liquid assets might have exhausted, there's the ability to draw down on the pension funds that sit above the line as well, which would extend their capital for further years. So the purpose of this really is just to give you a flavour of what a personal cash flow might look like. And really the outcome of this type of exercise, it enables us to talk about whether those long-term goals are indeed achievable or not. And then we can talk about the options available on the back of that. So for example, how do we look under the bonnet of personal finances and look under the bonnet of how you're running your business to identify perhaps some efficiencies in the way that we've organised our affairs in order to give that individual the best chance of achieving those long-term goals and objectives. So I guess in summary really, you know, the value of having such a plan, number one would be clarity, you know, knowing the truth about your finances, having a clear strategy which enables you to link your personal objectives to the performance of your business. An exercise like this can help provide a sound rationale for making decisions about your financial future. Other benefits would be, you know, knowing what sort of growth is needed within your business and with your personal assets in order to meet your long-term needs. And finally, you know, knowing how much risk is appropriate would be a big one as well. So essentially, it's uncertain times, you know, focus on what you can control, have a plan, keep it up to date, and be disciplined and stick to that plan would be a good thing to consider. That's it from me. Back to you, Andrew.
Thank you, Tony. That was fantastic. I'm conscious of time. We're running up to the 45-minute mark. So really that brings us to the end of this, this session. I'd like to thank all of our live viewers for participating, and also thank our three panelists for some really great insights this morning, a very comprehensive, detailed session. We will be returning on Wednesday, the 1st of July to continue the conversation I think Mark Neath, our corporate finance specialist, will be joining us with a guest speaker where we can answer more of your questions. So in the meantime, thank you very much for joining us today. Goodbye, and in the interim, please stay safe.